Hello trader, welcome back to the channel, and today we're going to talk about the market structure and the price action. The first question is, what the difference between the price action and the market structure? The price action actually is what the price is printing in the chart. The chart is the market is closed, so the price here is not moving, and this is the price action, though what the action that the price is doing in that exact moment, right? And the market structure is the result of the price action. So is the result of the price action, what the price did during a long period of time. That is the result. That is the market structure. We have to understand that us as retail traders and big institution, we are moving, okay, the price. So we are actor on the price action, but big financial institutions have the really big intention, and they are only them can move the market, right? So what we have to do now is understand what those big institutional banks or whatever are doing. We have to stay in the shadow of their shadow. So that is what we are doing right here, because when they move the market, because they have the intention, they have the intention, and they can effectively move the market. What we have to understand is understand that footprint that they are leaving during those price action, and try to understand where is going to be what's going to be the next move, and utilize that in our trading, and of course making money, right? So that is really, really important. We have to understand also that in the price action, the price do not move like to go to the point A to the point B. Is not a straight line. It doesn't work like that, right? In the chart, we have up, down, up, down, up, down. Why that kind of movement or pattern is really, really simple. Just imagine by yourself, maybe to travel from a country to another, from Italy to France, for example. Okay, there are many kilometers. Of course, your speed do not be the same during all that travel, right? You will travel maybe around to, I don't know, 100 kilometers, and then slow down, and maybe 80 kilometers per hour, and so that way, right? It's not constant and just a straight line. Absolutely not. Maybe you will drive with this speed for, I don't know, 200 kilometers, and then maybe you will go to the bathroom, so you will slow down the speed till maybe this level here, and maybe eat something, and then start to travel again. So we're gonna go at that level. So the market is doing exactly the same, right? So it doesn't work that way, that just move like in one way and one straight line. So now I would like to respond to some questions and some curiosity about that. Why utilize the market structure instead of the indicators? In my trading, I don't use indicator. I don't use any more indicators. When I start trading, I use a lot of indicators because it's like kind of simple things on the charts. Those fancy indicators like moving averages, RSI, they works, okay? They works because there's no perfect strategy in the market. Everybody has to understand what works for him and just utilize that. But for sure, understanding the market structure will help you, and to understand what indicators do not show you, right? Because another thing that behind the indicators is that the indicators are lagging, okay? They're lagging, and they arrive late. You can say that they arrive really late. So understand the market structure will help you to don't need them anymore while you are trading, right? So, for example, it's still better, the market structure, than support and resistance levels. Why? Because I can jump into this chart. I will just put, like some random lines in the chart like this, for example, right? If I move a little bit behind, you will say that here, look at this, beautiful. Here at this level, I should have here a resistance, and that resistance is react, and then the price comes down and react to this support, and then goes up, maybe break again, those fancy stuff. Look at this, beautiful. You should say, look at this, the price react perfectly in that level. But when you are trading, even a single pipette can be really, really important. So you see those random things on the chart, they are not the best, they are not the best. They are random, and anybody can just jump into the chart and put those lines, a lot of lines, and with no sense, my point of view. But for sure, it's something that works for somebody else. It's just to make you understand that you don't need those lines, those support resistance, or those indicators while you are trading market structure, because you really understand what is going on in the market, right? So now, why the market creating sequence of pushes and pullback? Of course, because, for example, here we can see that maybe the big boys in the market comes in and push that up, right? And this pullback means that when they arrive there, they liquidated their position, and then the price goes down a little bit. And because maybe we have another concept that is the the zone of premium and discount. So that was really high. They have to create a discount in the market before push again below the 50%. Here I draw it on the chart. This is another push right here. This time the discount remained, we can say that the pullback remained in the premium phase, but eventually it was okay for the market at that level to keep pushing up, right? So those kind of correction is just to like take a breath, or build other liquidity, other level of liquidity inside the market before, build the liquidity mean let more people enter in the opportunity, and then move the market from to a direction or another, right? So now the other question can be, when do we confirm a high or a low? This is a high because we are in the bullish phase, right? And in the bullish phase, we form those high and high and low. The high is higher than the previous high. Okay, we are forming a new high that is higher than the previous one. So that's why high and low, because this is a low, and this is another low, and this low, this high and low is higher than this previous one. Okay, so that the difference between or the definition of high and low. The same thing in the low and high and low. Okay, just the opposite way to say it. Now, many times in the market, we can observe that the push phase have like less candles, and the movement is really big, and the pullback phase has a slower movement. Like, for example, here is low, we have more candles, okay, printing out in the pullback phase than the pushing phase, right? So we, for example, here, for example, look at this, we have the push up, and then the pullback phase have only more candles, 2 candles, for example, right here, and then we push up again. Here we have the pullback phase formed by 1, 2 candles, and so on. Okay, guys, so this is a brief introduction of the market structure, why the market structure is so important, and why you don't need those indicators on the market, those fancy stuff. My chart is always this like this, and when I come in and I just mark some zone. And in the next videos, we're gonna understand how to draw them on the chart and so on. So guys, again, smash the like button below, subscribe to the channel for more videos. I will be updating everything and build this journey all together. See you soon and ciao.